distinguished guests, and also a live audience online, and also here in China, and also throughout the world. So I'm very pleased to host today's exchanges with the World Bank. Distinguished guests, and also a live audience online, host this special edition of latest report of Global Economic Prospect report. As we all know that the COVID-19 pandemic has had a huge impact on the world economy, with major economies experiencing a steep decline in economic growth. So rising from unemployment rate and the reduced cross-border investment, and also inflation in particularly. So in responding to this pandemic, countries in other parts of the world, and also including China, have adopted fiscal and monetary policies to combat this kind of economic slowing down, and even the the crisis sometimes. And particularly on top of the pandemic, we have this Ukraine conflict that really disrupted the world economy and the supply chains, and also the high inflation we see, also volatile markets of the global stock market. So in this context, actually, after January report, we are now in the second term of this year that the World Bank has released the latest Global Economic Prospect report. So we are very pleased to co-host this latest Global Economic Report release here in China. So the June Global Economic Prospect report offers the first systematic assessment on how current global economy and also the global development compare with the stagnations of the 1970s, with particular emphasis on how stagnation could affect emerging market and the developing countries. The report also offers fresh insights on how the wars, actually, the Ukraine war's impact on energy market, and also clouding the global growth outlook. And also, as we know, the pandemic actually is lingering now into its third years. Over the past 2.5 years has really dragged the global economy, and also has a huge impact on China. So I know that our colleague at the World Bank has really given the latest assessment very timely, and also will be a big reference for all the policymakers, business community, and also academics, to really see what's going to be the latest efforts that we can all work together to combat this slowing down. So we're very pleased today actually to be joined by three distinguished World Bank experts. First is Dr. Ayhan Kose. He's the Chief Economist and the Director of the Prospect Group in the Equitable Growth, Finance and Institution Practice Group of the World Bank. And so he's the member of the EFI leadership team overseeing the practice of growth policy, operational and analytical products. Under his management, the Prospect Group produced the bank's corporate flagship report, Global Economic Prospect. I mean, this is already the 5th time we're working with Dr. Kose. I'm very pleased to welcome Dr. Kose to join us. And also, we are going to introduce a new expert this time. We're having Mr. Ibrahim Chowdhury, Chowdhury. He's the World Bank Senior Economist for China. And he's the Senior Economist for China based in the World Bank Beijing office. And before joining the Beijing office, Ibrahim spent 4 years in Cairo, where he led the bank's work on economic policy analysis on Egypt. He joined the World Bank in 2012 in the Credit Risk Department, where he was the country coordinator for a range of countries, with particular focus in the Middle East and North African region. So welcome, Ibrahim. And also, finally, last but not least, we are also having an old expert on this webinar. We had 5 times, Dr. Ekaterine Vashakmadze. So Ekaterine is a senior country economist in the Perspex Group in the Equitable Growth, Finance, and Institutional Practice Group at the World Bank. In her personal job, she leads the macroeconomic monitoring and economic forecasting work for the East Asia and Pacific region. So welcome all our three distinguished World Bank experts. So I think now we are having this live event, and it's particularly for China. We know that you just released the Global Perspex report recently in Washington, and this is time now you are leading international China. We really like to have Dr. Kose to first present us what is your latest assessment, where are we now, what are the next 6 years, next 6 months forecast, and also for the particularly, also you have adjusted a lot of based on your January and also last year forecast. So what are those reasons behind your adjustment, and what are the latest trend and development that you can give us, share with us? We're really interested. We have a simultaneous interpretation. We have both English and Chinese channels, and we're broadcasting through many multiple social media online. So Dr. Kose, I'd like to invite you to give your report presentation first, and let's welcome Dr. Kose.
Thank you, Dr. Wang. It's just such a pleasure to visit you once again virtually. We talked right before we started. I'm hoping that one of these days we are going to spend time in person, break bread together. But I'm very happy that we have this opportunity, and I greatly appreciate, of course, Center for China and Globalization, the global economy, basically the leading think tank in China, giving us this platform. It is indeed, this is our first outreach event, public in the continent. We released the report last week on Tuesday, and I'm very happy. Ekaterine Vashakmadze is with me. We have this little tradition now we established. This is the 5th time we are doing, and of course, so great to have Ibrahim Chowdhury, our now expert on the ground, and he follows China very closely. I'm going to talk about the global economy mostly, and then Ibrahim is going to talk about our views with respect to China. Let me quickly present a current
Recording
period
in progress.
in the 1970s. And then, of course, we have a piece about the implications of the war for energy markets and activity. I'm going to focus on 3 questions. First, what are near-term prospects for the global economy? In a nutshell, we are expecting a much sharper global slowdown than what we expected in January 2022. And we have broad-based forecast downgrades. And there are multiple risks, and these risks cloud the outlook. The second question I'm going to focus on, what does this stagflation mean for emerging market developing economies, having this high inflation and low growth around the world? And there, we basically go back to 1970s. It was the only time the global economy really truly experienced stagflation worldwide. And this, the important observation is that the 1970s stagflation episode ended with a series of financial crises in emerging market developing economies. Here, we are going to use this acronym EMDs that stand for emerging market and developing economies. And these economies are again facing a rising risk of a similar outcome, especially those economies highly leverage the huge stock of debt. And then the third question, what are the policy priorities for these economies? There are important things the global community can do in terms of coordinating policies, but balancing macroeconomic policy trade-offs is going to be critical. So let me start with the first question. I think people know that we have one of the largest commodity price shocks we have seen in history. energy prices increased since 2020, around 300 energy prices since the 1970s. The increase in food prices we have seen is the third largest. And I think the people also know financial conditions are tightening and tightening quite rapidly in this country, in the United States. There is this Federal Reserve meeting tomorrow. They are going to announce the interest rate increase that will, in all likelihood, add more to this tighter financial conditions. And the third important thing, global trade is slowing. At the beginning of the year, we expected trade growth to be around 5.5%. We are now expecting that number to be close to 4%. So external environment for emerging market developing economies is increasingly unfriendly, to say the least. Against this background, we downgraded our forecast for the global economy, advanced economies, for emerging market developing economies this year and the next year. At the beginning of the year, we were expecting global economy to grow around 4.1%. Now we reduced that number to 2.9%. Next year, we are not expecting much of a rebound. Growth is going to remain around 3%, and we downgraded the growth number next year as well. For advanced economies, we downgraded our forecast from 3.8% to 2.6% this year. And next year, we are expecting advanced economies, in fact, to continue slowing. In the case of emerging market developing economies, at the beginning of the year, we were optimistic. We were expecting growth around 4.6%, but now we downgraded that forecast to 3.4%. Next year, we are expecting an upgrade. One reason that upgrade is because of China. We are expecting is going to accelerate, but at the same time, we will see some of these major economies to deliver better growth numbers, especially commodity exporting economies, energy exporters. So why are we seeing this type of very serious slowdown? Of course, the war in Ukraine changed the dynamics dramatically, added to the increase in commodity prices. It was a true supply shock. You have much intense supply disruptions, and inflation is increasing around the world, reaching record levels. I'm going to talk about that. Financing conditions tightening, trade is slowing. With all of those, we also see fiscal policy support is being withdrawn. With that, of course, the consumption and investment also are going to slow. Those are the reasons why we have these downgrades. And one important observation about this slowdown, after 2020, there was a huge rebound. And of course, 2020 was a global recession year. So when we look at our forecast from 2022 to 2023, the slowdown that started in 2021 is going to be the sharpest slowdown following a global recession over the past 80 years. So we are going through a steep slowdown, policies around the world, fiscal and monetary policy being withdrawn for a variety of reasons. Of course, China is providing some support now to get ahead of certain issues in the context of COVID. Ibrahim will discuss these things. When we look at the regions, the story is pretty much the same. From 2021 to 2022, all regions except Middle East, North Africa region are expected to slow. And we pretty much downgraded our forecast everywhere except Middle East, North Africa, and we kept our forecast pretty much constant in the case of Sub-Saharan Africa. In East Asia Pacific, we are expecting a serious slowdown from the rebound last year. We downgraded the forecast. In Europe, Central Asia, because of the war, Russia and Ukraine will have significant contractions. We are expecting Ukraine to contract around 40%, Russia to contract around 8 to 9%. And then, of course, in Latin America, Caribbean, despite the increase in commodity prices, because of the inflation problem, we are expecting a very sharp slowdown from 6.7% last year to 2.5% this year. In the Middle East, as much as oil exporters are going to deliver higher growth numbers, the rest of the region is going to continue struggling, especially because of increase in commodity prices and food prices critically. Now, let me put these things in context. Here, you see the fraction of countries we downgraded. The color red shows you the fraction of countries we downgraded, and the blue upgraded, and the orange, no change. For the world economy as a whole, we downgraded more than 70% of countries. In the case of advanced economies, we downgraded growth for this year more than 80%. For commodity importers, we downgraded growth for more than 80%. In the case of energy exporters, of course, there were upgrades primarily because of how energy prices accelerated over the past 2 years. So global economy is going through a very steep slowdown, and this slowdown is highly synchronized. And there are multiple risks. They amplify each other, and in all likelihood, we might end up seeing even weaker growth. We discussed these issues in the report. Number one risk is associated with Russia's invasion of Ukraine and the geopolitical tensions. The war can intensify, can spread other parts. Of course, the challenges associated with the war, the commodity price increases, and supply disruptions can also magnify for a variety of reasons. The second important risk is the risk of stagflation. High inflation for an extended period of time and weak growth for an extended period of time. This risk today is much higher than 6 months ago. Inflation surprised on the upside persistently. Recent supply shocks associated with disruptions in commodity markets translated into record high inflation. Inflation was already high prior to the war, but because of the war now, we see increases, especially in many major emerging market economies. Of course, with the war, energy and food insecurity became a serious problem. We are worried about intensifying food insecurity in many countries, given the war, how the staples of main commodities basically are now subject to significant supply disruptions. Russia and Ukraine, they are major producers of multiple staple commodities, and with them out of the market, especially Ukraine, some countries will face a significant challenge meeting demands when it comes to basic food items. Whenever you have these types of the factors, stagflation, energy and food insecurity, you need to worry about social tensions. Of course, we are worried about those tensions as well. Additional supply disruptions, in addition to the COVID-related supply disruptions, are still with us, and we see supply disruptions because of the war. The Black Sea is pretty much closed to shipping traffic, and of course, still the supply disruptions are weighing on our growth of world trade. Financial stress is an important risk. In an environment, central banks are increasing interest rates, and in all likelihood are going to increase interest rates faster than what markets are expecting. And we have a number of emerging market and developing economies with elevated debt levels. COVID-19 outbreaks is an important risk, and we see how debt risk manifests itself in major emerging market economies. I did not talk about climate-related risks, but those risks are with us. With these, we are also worried about fragmentation of trade, investment, and financial networks in an increasingly difficult external environment emerging market developing economies are facing. Let me turn to the second question. Why should we worry about stagflation in the context of emerging market developing economies? So most commentators focus on the United States when they think about the stagflation threat. But the stagflation threat is global. You look at the inflation rates, inflation is multi-decade highs in the world economy. It is at the highest level for advanced economies since the early 80s, for emerging market developing economies since the early 2000s. At the same time, we also see rapidly slowing growth. I already talked about that. But the growth slowdown in all likelihood will continue in 2020s. Our estimates suggest that we will see on average 0.6 percentage points lower growth in this decade than what we saw in the previous decade. So there is this possibility. In an environment you have limited fiscal space, in an environment there is limited appetite for structural policy interventions, and of course, tightening financing conditions, we will see tepid growth for an extended period of time. We had this problem in the 1970s. And in the 1970s, we also saw sharp increases in commodity prices, especially oil prices. During 1973-74 and 78-79, there were major oil price shocks. Growth was weak. And at that time, monetary policy was highly accommodative throughout the decade for a variety of reasons. So what are the big similarities of the current period with the 1970s? The first similarity is high inflation. Inflation average in the 1970s around 10%. Now we have inflation around 8% at the global level. In the 1970s, we had a very sharp slowdown following the 1975 global recession. We now have even a sharper slowdown following the 2020 global recession. In the 1970s, we saw this, of course, recession following the oil price shock of 1974-75. That was a supply shock. This recession and following, of course, the slowdown after the rebound, also driven by supply shocks partly, and of course, the types of policies policymakers ended up implementing for good reasons, at least this time. But during the 1970s, for an extended period of time, monetary policy was accommodative. Global real interest rates were negative. On average, 1970 to 80, around minus 0.5%. Now, if you look at the average global real interest rate since 2010, it is around minus 0.5%. In the 1970s, emerging developing economies accumulated significant amount of debt. And now in 2010s, they accumulated even more debt than, what we saw in the 1970s. That period ended with aggressive tightening of monetary policy by the United States that triggered a global recession in the early 1980s in 1982, and a string of debt crises in emerging market economies. So the risk is that we will end up having the same outcome because of these similarities. What are the big differences that should keep us a little bit optimistic? Central banks around the world, major central banks, have better monetary policy frameworks. In the 70s, they did not have these frameworks. And there are many countries, they have accumulated significant amount of credibility as they target inflation. Wage pressures in the United States are quite high now, but those wage pressures were even higher in the 1970s. Labor markets are more flexible. Of course, that's quite important to prevent this wage price spiral. So there are good reasons to worry about stagflation, and there are some good reasons to hope that central bankers can overcome that. Let me quickly talk about the policy priorities. There are some policy priorities at the global level, and that starts with mitigating the effects of the war in Ukraine, supporting humanitarian relief efforts, and finding ways to overcome the food insecurity in vulnerable countries. Beyond that, it's going to be important to find ways to promote green, resilient, and inclusive recovery. That starts with, of course, aggressive vaccination campaigns. Still in low-income countries, vaccination rates quite low. Providing debt relief where needed. That debt relief should be quite speedy and comprehensive, and facilitating energy transition away from fossil fuels. And I think now we have even a greater incentive in light of this war to accelerate the green transition. Beyond that, it's going to be very important we bolster rules-based international economic order to guard against this risk of fragmentation of trade, investment, and financial networks. At the national level, policymakers are going to face a big test, and that test will require them to be credible, to be clear, and to be determined in their implementation of monetary policy, fiscal policy, and financial policy. And they need to basically push forward with structural policies to improve growth outcomes. So let me conclude with a quick summary. First question, what are near-term prospects for the global economy? We are going through a historical slowdown. It is the sharpest slowdown we have seen since early 1940s, following a global recession episode. There are multiple downside risks clouding the outlook. One of the most important things is the risk of stagflation. It presents significant challenges for emerging developing economies. That's the second question. And the big challenge is that whether these economies can be resilient in an environment financing conditions are rapidly tightening. In the 70s, they were not resilient. And of course, we saw the largest number of debt crises during the 1980s in terms of in one decade, how many debt crises we have seen. The third question, what are policy priorities? And I think both the global community and national policymakers need to address the immediate challenges confronting the global economy. Let me thank you again, Dr. Wang, and I invite all the members of the audience to check our recent publications looking at the challenges confronting the global economy. We have a number of them. Thank you. Back to you.
Yeah, thank you, Ayhan, for your very comprehensive but also very forward-looking analysis, and particularly with all those policy recommendations, policy options that are available. And also, I think you have really outlined the seriousness of this situation we're facing. It's really since 1930s, 40s we are actually going that far. And there's a lot of similarities between now and 1970s. Those crises that we went through. So it's so important that we have this international consensus and international attention, and with the World Bank analysis situation, how we can quickly get out of that, and how we can quickly, this world economy of geopolitical tensions, but also these trade restrictions, trade liberalization, and also how we can really strengthen the free flow of global trade. Those are really important issues. Now I'd like to invite Ibrahim, our World Bank Senior Economist here in China, to give your assessment on, combined China, but also in the region. What's your take on this series and your reflection of this report, and how that can be really reflected here in China as well? So Ibrahim, your please.
Thank you so much, Dr. Wang, and good morning and good evening. Thank you for having me today. It's a great pleasure to be with all of you. Let me share my screen. Okay. So we started the year relatively strongly. In January, February, things looked pretty good, but then we have seen this large COVID outbreaks in Shanghai, and they have disrupted China's growth normalization. And on top of the COVID outbreak, China is also facing a slowdown in the housing market, which is an important sector for China's economy. And on top there, the external shocks due to the war in Ukraine, which is also weighing on economic activity in China. And given all of these headwinds, we have actually revised down China's real GDP growth for this year to 4.3%. And this marks a downward revision of 0.8 percentage point relative to our China economic update that we had released back in December. And the downward revision really largely reflects the damage caused by the Omicron outbreaks. And even with this growth projection, we still see a number of risks which are unevenly balanced, and they are skewed to the downside. I think the main risk is that we have further COVID shocks that could disrupt economic activity. There's also the risk of more persistent stress in the real estate sector, which could also weigh on the economy. And then there are the risks related to the global outlook that Ayhan just presented. However, there could also be an upside risk to economic growth. And this upside risk could materialize if the COVID situation is controlled more effectively, if economic disruptions are of lower magnitude, and if there are fewer COVID restrictions, then we can see growth being potentially higher than what we currently envisage, helped also by the additional stimulus measures that the State Council announced about 2 or 3 weeks ago. But in the near term, I think the main challenge that China is facing is how to mitigate COVID while also supporting economic growth. And one of the concerns we have is that as outbreaks continue and mobility restrictions persist, this could limit or reduce the effectiveness of policy stimulus. And then over the medium to longer term, there is a risk that China remains tied to its old playbook of stimulus-led investment, whereby policymakers ramp up infrastructure investment and real estate investment. But this risks that China might end up with more debt in the future. So as China aspires to achieve high quality growth, it's important that decision makers strengthen efforts to rebalance the economy more towards consumption, more towards services, towards green industries, and assign a larger role for markets and the private sector. So just very briefly, as I mentioned, China had seen this large COVID outbreak, which has really severely disrupted economic activity. On the positive side, the outbreaks have gotten under control relatively quickly, but we do continue to see recurrent outbreaks, and even though the situation in Shanghai has started to normalize. There are still many restrictions, mobility restrictions in place that continue to hamper economic activity. Ayhan already alluded to the commodity price shocks and the tightening of global financial conditions, so I will not go into this. Now, for the first quarter, China was still able to, record a relatively robust growth rate, despite the deteriorating global environment and despite the impact of new Omicron outbreaks. And the rebound in growth, as you can see on the right-hand side, was really predominantly driven by investment, and especially by a recovery in infrastructure investment helped by strong policy support, but also robust manufacturing investment. In contrast, consumption has stagnated due to deteriorating consumer confidence, a challenging labor market, and also due to the tighter mobility restrictions. We don't have the Q2 growth data yet. They will be released in a month from now, but we do have higher frequency activity data. And clearly you can see that towards the end of the quarter, the Omicron shock had a pretty large impact on economic activity, which was very broad-based and affecting both the supply side, but also the demand side. And similarly, we also looked at some of the mobility indicators. On the right-hand side, you see an indicator that measures truck freight flow. And you see that while in many places this indicator has recovered, in Shanghai it's actually still, points to still tightened mobility restrictions. The outbreaks in Shanghai and the lockdown in Shanghai have also impaired trade activity. As you can see here, following a strong first quarter, export growth has actually declined sharply in April, but figures that have just come out actually show a small rebound in May. Similarly, due to weak domestic demand, import growth has also contracted in March and remained flat in April. But we've seen some recovery, modest recovery now in May. Overall, we find that the commodity price shock actually has had a limited impact on China's trade balance, even though China is a net importer of energy commodities. So China essentially stepped up its domestic production of key energy products such as oil, gas, and coal. One area that I think worries us is the deteriorating labor market situation, where we have seen quite significant increase in the unemployment rate across different measures. Both headline unemployment rate has increased, but also youth unemployment rate has also increased substantially, driven both by the pandemic, which has affected the demand and supply side of labor. And as you know, the upcoming graduation season this year will release a record number of fresh graduates of almost 11 million graduates in the labor market. And so far, the economy has generated less new urban jobs in the first 4 months compared to last year. With all of this in mind, policymakers have embarked on aggressive policy stimulus, especially fiscal stimulus. The budget that was released, this year's budget that was released in March, according to our estimates, points to a fiscal stimulus of up to 2.7% of GDP. It could be a little higher if you add the recently announced measures. But most of these measures focus on the supply side. They're also geared towards ramping up public infrastructure investment through the issuance of local government special bonds. Monetary policy easing has been a bit more modest, with most of the policy support directed towards window guidance, which is targeting credit to priority sectors, while at the same time trying to avoid an increase in debt. In addition, policymakers have also introduced a number of measures to support the real estate sector. These include easing home purchase restrictions, but also a cut in the 5-year loan prime rate, which is the interest rate that serves as a proxy for mortgage rates. Still, despite the regulatory policy easing, we see that the housing market still faces a lot of challenges. Home sales, whether you look at volumes or values, remain in deep contraction. And similarly, access of many property developers to debt markets, whether it's onshore or offshore, remains limited. So with all of these headwinds, we project the economy to expand by 4.3% this year. And this is significantly below China's potential growth. And there are a number of assumptions that feed into our growth projections. First, we assume that China's current COVID strategy will be maintained this year. We also assume that COVID outbreaks will continue, but they will be of less disruptive nature, as China will hopefully become more effective in handling these outbreaks. Still, we envisage that activity will normalize only very gradually because of weak confidence and also declining exports. So we don't assume a V-shaped recovery. And lastly, we also don't assume additional fiscal stimulus beyond what has already been announced. Now, when you look at the composition of aggregate demand this year, we envisage a shift in the structure of aggregate demand more to domestic demand. Last year, net exports played an important role in supporting China's economic growth. This year, we see less growth impulse from net exports. As Ayhan mentioned, the global economy is projected to slow significantly. But within domestic demand, we'll see more of a shift towards investment, helped by the government's fiscal policy stimulus, which should support infrastructure investment. As I mentioned, there are a number of risks and downside risks to our outlook prevail. First of all, there is the risk that we could see prolonged COVID outbreaks that could impair both the supply and demand side. And in such a scenario, it will be difficult for fiscal and monetary policy to really offset the impact on economic growth, because in such a scenario, such stimulus could be more less effective for the reasons I had mentioned before, and instead could lead to a buildup of further financial risks. Second, there could also be more persistent stress in the real estate sector, which could also, my apologies, which could also lead to wider macroeconomic and financial repercussions. And then lastly, the war in Ukraine could also lead to much larger external shocks. It could lead to higher energy prices for longer, lower global growth for longer. All of this would weigh on China's growth outlook. All this said, however, we also want to flag that there is an upside risk to our growth outlook. And this upside risk is that if COVID is controlled more effectively with fewer restrictions, then growth could be higher thanks to the recently announced additional stimulus measures. Lastly, I want to also flag a number of medium-term challenges and longer-term challenges that China is facing. And first, of course, is the handling of the pandemic, on which I elaborated during my presentation. Then there is the property market slowdown. But as you know, China has also been facing stagnant productivity growth. It's facing demographic headwinds. The working age population is slowing. A number of local provinces are straddled with high levels of local debt. And China also needs to tackle inequality. So all of this said, I think China, and this is something we have flagged in our previous reports as well, that if China wants to achieve high quality growth, it needs a different type of growth model. It needs one that gives greater emphasis to consumption, to services, green industries. If China continues on the current path, there is a risk that leverage debt increases further, especially corporate sector debt among property developers. But there's also the risk that debt in many local governments is also increasing further, and this would limit policy room going forward. But first of all, I think what is critical is that China needs to plan for an exit from its dynamic zero COVID strategy. With this, let me end, and thank you again for giving me the floor today.
Yeah, thank you, Ibrahim, for your very comprehensive, but also quite focused analysis of the in light of this global economic perspective with the World Bank, but also really looking into the detail of what's going on in China. So you have to give a lot of useful and stimulating recommendations, analysis. So really a great reference, I think, for all our policy makers, but also business and academics. And now we have about 10 minutes left. Let's into some kind of discussion. We know that China is, as you said, is in this COVID affection, late waves that really dampen and slow down China's economy. And also, World Bank has lowered its forecast from 6 months ago, above 5% now to 4.3 now. So that's really a challenge that I think China is facing, and also now the whole world is lifting, this zero COVID, and a lot of travel ban has lifted. So what do you think? I oppose to all three of you. What do you think of this final moment, where the whole world is open, and China is really with this COVID strategy that really has, through your analysis, you can see that really has slowed down the economy, and how that's sustainable. I'm surprised to see the commodity prices hike doesn't really affect China, as you mentioned. But even though China 70% of the energy depends on the import, and also largest food import as well, but this mobility of labor and also the employment rate employment is getting higher, and also this particularly this the supply chain gets stuck sometimes, are really taking the tolls, I think, here for the particularly in the March and April months. So how can we get out of that, particularly in the light of all the world economy is lifted, as also tourism, I mean, can be as many as 10% of GDP globally. How can we revive that and let vaccination and facilities to combat cases, and also particularly those economic policies, that tools that we can have. So perhaps I have one round starting from Ayhan. Maybe you are the head of Prospect Group at head office in World Bank. From this global look, how do you think China can do better from analysis we have today?
Thank you, Dr. Wang. Actually, I am going to ask Ibrahim, since his feet wet on the ground. He can provide a little bit of update, and Eka also work on the China update. She's one of the co-authors. And then I will provide a kind of a brief perspective about why it is high time for China to address certain challenges for the global economy. That will be, I think, better if we do that. It's okay with you.
Sure, absolutely. Let's do that. Yeah. So Ibrahim, why don't you start?
Sure. Since I ended the slide with the need for China to finding an exit of its dynamic zero COVID strategy, I think this will be a critical role. And what can China do? I think there are a number of things that China can do. First, I think it's critical that China increases the vaccination among its elderly population. I think it's also important that China increases its healthcare capacity, because both of these things together would ultimately allow China to reduce the stringency of its restrictions, and it would strengthen both consumer and business confidence, and thereby help improve the effectiveness of stimulus, and then support the recovery of domestic demand in the second half of this year. And when it comes to policy specifically, I think what matters is that policymakers calibrate support so that it's also aligned with the long-term structural shift in China's growth model. So this could mean, for example, that fiscal support could be targeted towards accelerating the green transition, for example, by providing time-bound subsidies for related private sector investment. This, in turn, would provide companies with the incentive to front-load investment, to reduce emissions, to create short multiplier effects that could also stimulate the economy. And China could also develop more effective means for handling the exit of unviable businesses and resolving insolvent financial institutions, because this in turn could free up resources and facilitate the reallocation of credit flows to more productive sectors, including green investment and SMEs. So I think these are some of the areas I would flag, and maybe Eka would like to come in as well.
Okay, thank you, Ibrahim. So Ekaterine, yeah, please.
Yeah, so thank you, Henry. I will be very brief because Ibrahim covered comprehensively answer to your question. But I think one issue which I want to highlight is that when you take these 2 years of post-pandemic recovery global, China is still leading in terms of how strong was recovered last year. So I think that targeting growth in these uncertain times maybe is something that will need to be carefully examined, because again, if we see the weakness in the rest of the world, and we see that China still recovered much stronger when you take 2 years. So the question is how we will go forward, right? And what will be driving global growth in terms of demand. And this, then I think the importance is not really the point growth this year or whether growth will be like whether China will achieve with more stimulus the target growth or whether it will be a little bit slower. But the question, the biggest question is that what will be the composition of growth? Because on demand side, as we all know, the biggest challenge with China was successfully overcoming was to rebalance growth from investment towards consumption. And this development has stalled with the pandemic, actually both years of the pandemic. And then on the supply side, as we know, the biggest challenge for China was that productivity growth was slowing. And then now we are again, because of the lockdown, seeing maybe risks to productivity growth going forward, and then more leaning towards investment growth. So I think that those are very difficult issues. And I think the policymakers are focusing on these issues, but those are really, to me, the front and center, because they will determine then the outlook for the coming years. Not this only year, but 23, 24. And then how China will contribute to the global growth and global strengths, right, of demand global. Thank you.
Yeah, thank you, Ekaterine. And so, Ayhan.
Yeah, so thank you. I think what Ibrahim and Eka clearly articulated, China has a great opportunity. There's a great challenge here, but there is a great opportunity, and that starts with improving the healthcare system. The good news in the case of China, there is incredible capacity, and there is willingness, and there is desire to do that. Of course, it is difficult to do these things when you are going through a pandemic. I think China showed incredible learning curve, very steep in early parts of the pandemic, very successful containing it. And now I think that building on that success, China needs to find a way to, moderate certain interventions while making sure that COVID cases are going to remain at a minimum. And at the end of the day, it is a pandemic. You need community immunity, which basically requires, in a perverse way, the spread of the disease. But I think your observation, Dr. Wang, is critical. The rest of the world is opening, and then we have three main engines of global economy: US, Euro area, China, and we need China charging, supporting the global growth. And there, I think that the health policy interventions ultimately need to take into account the economic toll associated with policy measures and calibrating those policy measures. And I really like how Ibrahim put it together, balancing the kind of the certain trade-offs, thinking through these carefully. I think that what Chinese authorities have shown repeatedly, they have a perfect grasp of the challenge. They intervene, they provide the necessary support, but this time it's going to require adjustment, calibration. And that's the kind of the policy advice we provide around the world, calibrating policies, thinking through different trade-offs, macro trade-offs, health-related trade-offs. So I think that as much as the bank downgraded the forecast this year, we still think China will deliver growth around 5% next year. And I think the kind of the hope is that China will do that for the sake of global economy and of course for China itself. But let me stop there, Dr. Wang.
Okay, great. Thank you for our three World Bank distinguished experts specific analysis on China. Of course, we have this, as Ayhan, you mentioned about these trade-offs, how we can really get the trade-offs. Ekaterine mentioned about, the growth model, are we going to rely on the past model now while we are taking this pandemic era, adjust that and more consumption-led model rather than all the investment-driven infrastructure stuff. So that could be also, Ibrahim talk about, how can we get, out of this dynamic zero COVID strategies, while maintaining the COVID occurrence at the minimum. So I think now, absolutely, we had at this critical moment now, and a trade-off is really where we need to strike a balance. I think China is really doing a lot of experiment with massive testing, but also keep the COVID at the minimum, but also the social cost at the minimum. So I think the key word is balance. We have to keep that balance. Maintain the growth is absolutely important and crucial. And also with particularly if the whole world is opening up, and China had to find a new way getting out of this challenging time and find a way to thrive. And as also I have mentioned, to continue to lead the world economy. So now this year we've been forecasted slowing down at 4.2, but let's see, next year we can continue to come back to 5, according to the World Bank. So that's really good news. So again, I think that this is a very stimulating, very eye-opening, and also provide a lot of a policy debate for the global economic perspective and also Chinese economic perspective. So this is really highly useful, highly informative, and highly referenced for our policymakers here in China and also around the world. So I want to thank both, of course, World Bank Group and our CCG staff to put up this webinar. We've done this 5 times now, every 6 months. We hope that we'll continue this tradition. It's absolutely important. And my staff was telling me that we have broadcast this on over 15 channels, and there's 250,000 people watching this lesson this online. So this is really great in both Chinese and English. So really, I want to thank Dr. Kose and Ibrahim, and also Dr. Ekaterine, for all your contribution. Also the World Bank China office for organizing with us as well. So we have to say goodbye, but let's keep in touch and let's continue our to hope the world economy gets better, and also to stimulate China economy gets better. Thank you all very much.
Thank you, Dr. Wang. See you in Washington, D.C. next time. Okay. Thank you.
Thank you. Okay.
Thank you, Dr. Wang.
Thank you, Dr. Wang, and thank you, everybody, the organizers. Thank you.